Here's something that will completely transform how you think about trading breakouts. 95% of retail traders make the same devastating mistake when they see price breaking above resistance. They hit the buy button immediately, convinced they've spotted easy money. What they don't realize is they've just walked into the most expensive trap in the market. Today, I'm going to show you why buying breakouts without proper validation is financial suicide, and more importantly, how professional traders separate legitimate moves from the fake ones that destroy accounts. The difference between these two approaches isn't just a few percentage points in returns. It's the difference between consistent profitability and joining the graveyard of failed traders. Let me paint you a picture that happens every single trading day. Price consolidates near a significant resistance level for weeks. Retail traders watch, getting more excited by the day. They start positioning themselves, convinced the breakout is inevitable. Then boom, price finally pushes above that level. Within seconds, thousands of buy orders flood the market. Everyone wants in on what looks like the beginning of a massive rally. But here's what actually happens next in most cases. Price stalls, it hesitates. Then it reverses violently, trapping everyone who bought the breakout. Those traders who were so confident just minutes earlier now watch their accounts bleed as they hold positions that are moving against them with brutal efficiency. This scenario plays out countless times across every market, every time frame, every single day. The vast majority of breakouts are nothing more than market manipulation designed to extract money from eager traders who mistake price movement for genuine opportunity. Professional traders understand something that amateurs don't. A breakout by itself means absolutely nothing. It's not a signal to buy. It's simply a signal to start paying very close attention. It's the beginning of an investigation, not the conclusion of one. The legendary traders who built fortunes in the markets didn't chase every breakout they saw. They developed systematic methods for distinguishing real moves from fake ones. They demanded proof before risking significant capital. They understood that patience and validation were far more profitable than speed and assumption. So, what exactly constitutes proof when evaluating a potential breakout? The first piece of evidence comes long before price ever breaks resistance. It's found in the character of the preceding consolidation pattern. A legitimate breakout emerges from an orderly, well-defined base that shows signs of quiet accumulation. Price action during the consolidation should be controlled and methodical, not chaotic and erratic. When you see wild swings, multiple false breaks, and disorganized price movement during the consolidation phase, you're looking at a pattern controlled by retail traders, not institutional money. Professional money creates orderly patterns. Retail money creates chaos. No sustainable move ever begins from a chaotic foundation because the smart money isn't involved. The second critical piece of proof is volume behavior at the moment of breakout. This is where most traders get it completely wrong. They see price breaking resistance and immediately assume it's legitimate, regardless of the volume accompanying the move. This is a fatal error. A genuine breakout must be accompanied by explosive volume expansion. Not just slightly higher volume, but dramatically increased participation that signals institutional involvement. When large players decide to move a market, their activity creates unmistakable footprints in the volume data. Think about it logically. Retail traders don't have enough combined capital to sustain major market moves. Only institutional players possess the financial firepower necessary to create lasting trends. When these players act, volume explodes because they're moving massive amounts of capital in concentrated periods. A breakout on light volume is essentially worthless from a professional perspective. It signals that only retail traders are participating, which means the move lacks the sponsorship necessary for continuation. These low-volume breakouts are often deliberately engineered traps where smart money distributes shares to eager retail buyers. The third piece of validation comes immediately after the breakout occurs. This is where many traders who correctly identified legitimate volume expansion still manage to destroy their accounts. They assume that because the breakout had proper volume, they can now relax and wait for profits to accumulate. Professional traders know better. They demand immediate confirmation through price behavior in the hours and days following the initial break. A legitimate breakout doesn't hesitate. It doesn't look back with regret. It moves with conviction and purpose, quickly establishing distance from the breakout point. If price breaks resistance and then becomes sluggish, makes minimal progress, or worse yet, falls back below the breakout level, the market is providing clear evidence that the move was false. This immediate follow-through behavior is crucial because it reveals whether the buying pressure that created the initial breakout was sustainable or temporary. Many traders make the mistake of holding positions through weakness after a breakout, hoping the market will eventually prove them right. This hope-based approach destroys more trading accounts than almost any other single factor. When the market provides negative evidence through poor follow-through, professional traders accept the verdict immediately and exit with minimal damage. The fourth validation requirement involves analyzing the first pullback after the initial breakout thrust. Every legitimate move experiences temporary corrections as profit taking occurs and new buying interest develops. The character of this first pullback provides essential information about the underlying strength of the trend. In a genuine uptrend, the first correction should be orderly, and most importantly, it should occur on significantly reduced volume. Light volume during pullbacks indicates that institutional holders aren't selling their positions aggressively. The selling pressure comes primarily from short-term profit takers and nervous retail traders. This creates an environment where supply is limited and easily absorbed when buying interest returns. After this brief, quiet correction, legitimate trends resume their advance with volume increasing as price moves higher. This pattern of behavior confirms that the stock or market is in strong institutional hands. Conversely, when a pullback is sharp, deep, and accompanied by heavy volume, you're witnessing institutional distribution in real time. This signals that the original buying wasn't sustained and that large players are now aggressively selling into any strength. The trend's legitimacy becomes highly questionable at this point. The fifth piece of evidence requires looking beyond the individual security to its peer group. Legitimate market moves rarely occur in isolation. They're group phenomena driven by sector-wide or market-wide forces that affect multiple related securities simultaneously. When evaluating a breakout, professional traders immediately examine how other stocks in the same sector are behaving. If a leading technology stock breaks out, they want to see sympathetic strength developing in other major tech names. These related securities don't need to break out on the same day, but they should show signs of similar underlying strength. They should be approaching their own resistance levels, showing increased volume, and exhibiting constructive price action. This group confirmation provides evidence that a fundamental force is driving the entire sector higher, not just company-specific news or temporary manipulation affecting a single stock. When a stock breaks out while its sector peers remain dormant and lifeless, that's a major red flag. It suggests the move is isolated and therefore vulnerable to reversal. Professional money rarely flows into just one name within a sector. It typically creates broad-based movements that lift multiple related securities. The sixth and most important validation comes from the overall market environment. Even the strongest stock with perfect technical setup and ideal group action can fail if it's fighting against a hostile broader market trend. Professional traders demand that the general market direction aligns with their individual trades. For long positions, they want to see the major market indices in confirmed uptrends, making new highs, or at least showing constructive behavior. Trying to profit from individual stock breakouts during broad market declines is essentially betting that one security can defy the gravitational pull of the entire system. While this occasionally happens, it's not a strategy that produces consistent results over time. Professional traders always seek to have the powerful force of the general market trend supporting their positions rather than working against them. This brings us to perhaps the most dangerous mistake amateurs make: anticipation. They see a stock consolidating near resistance and become impatient. Instead of waiting for the actual breakout and subsequent validation, they buy inside the trading range, hoping to get a better price. This anticipation is pure speculation based on hope rather than evidence. By purchasing before the breakout occurs, traders expose themselves to significant risk if their timing is wrong and the stock breaks down instead of up. They might save a small amount on the entry price if they're correct, but they risk substantial losses if they're wrong. Professional traders willingly pay slightly higher prices after breakouts occur because that extra cost represents insurance. It's the price of confirmation, the cost of waiting for the market to reveal its true intentions rather than guessing at them. The methodical approach to breakout trading involves using small initial positions as probes to test market behavior. Instead of committing full capital at the first sign of a breakout, professionals use exploratory positions to ask the market a simple question: is this move genuine? The market's answer comes through immediate price behavior. If the probe position moves against them quickly, they have their answer and exit with minimal damage. Only when the market provides positive confirmation through continued upward movement do they consider adding to their positions. This approach ensures that the largest positions are held during the most favorable conditions, while limiting risk during the uncertain initial phase of any potential trend. Each addition to the position is earned through continued market validation, not blind faith in technical patterns. The key insight is viewing breakout evaluation as a judicial process rather than a gambling opportunity. The initial breakout is merely an opening argument, not a final verdict. Professional traders act as judges, demanding to see all the corroborating evidence before rendering their decision through position sizing. They listen to the testimony of volume, observe the character of follow-through action, analyze the behavior of the first correction, examine the strength of related securities, and consider the overall market environment. Only when all evidence points in the same direction do they commit significant capital. Buying breakouts without this rigorous validation process is the hallmark of amateur trading. It represents hope-based speculation rather than evidence-based investment. The market consistently transfers wealth from impatient traders who act on assumptions to patient professionals who demand proof before risking their capital. Understanding this fundamental difference in approach separates those who consistently profit from market movements from those who consistently feed their capital to more disciplined participants. The difference between profitable traders and the 90% who lose money isn't found in some secret indicator or expensive course. It's found in their willingness to demand proof before acting. While amateurs chase every breakout they see, professionals sit back and let the market prove itself first. Every single validation step we've covered today serves one purpose: protecting your capital from the market's endless deception. The orderly consolidation pattern, the explosive volume, the immediate follow-through, the controlled pullbacks, the group confirmation, and the supportive market environment. These aren't suggestions, they're requirements. When you start approaching breakouts like a detective gathering evidence rather than a gambler chasing action, everything changes. You stop being the prey and start becoming the predator. You stop feeding your money to patient professionals and start taking money from impatient amateurs. The markets will always reward those who can control their impulses and wait for genuine opportunities. They will always punish those who mistake activity for productivity. This isn't opinion. This is mathematical certainty proven over decades of market history. So the next time you see price breaking above resistance, remember what you've learned today. Don't reach for that buy button immediately. Instead, start your investigation. Demand your proof. Let the amateurs chase the false moves while you wait for the real ones. Your account balance will thank you for the patience.